Now, again, I'm watching the divergence that has developed between Nvidia and the NASDAQ. NASDAQ follows Nvidia. And I told you that after earnings that we were going to likely hit this trend line, which we did. We turned off of it with earnings. We dropped 14%. We bounced off support here at Nvidia, and I told you to be watching for a bounce back up for a right shoulder. Maybe that's done, maybe it's not, maybe there's more work to be done, but again, it is possible that it is completing, so something worth paying attention to here as we move into the Fed meeting. It is still possible we go back up and test this trend line again, and if we do, slamming into the weekly trend line, which I've talked about. I'll show you that chart next week. Don't have time today, but if we break this trend line on Nvidia in the weekly time frame, then that will confirm the pattern, and again, that would be extremely bearish for the stock market. NASDAQ has this divergence that gave us the sell-off back to the 50 period, back to gap support really. We got a bottoming tail there. We gapped higher with the CPI. We gapped down with the PPI inflation data. And then we had to push higher on Friday, push back down to try to fill the gap, and then push back up. And again, that formed a doji candlestick in the daily time frame. So does this divergence give us some kind of sell-off? So what I'm watching for is, you know, I talked to my last update in great length and detail about the S&P 500. And S&P did not make a new high here with NASDAQ. Okay, it's the previous week's high is still holding. NASDAQ got a new high this last week here. NASDAQ and Nvidia are diverging. Will NASDAQ and S&P diverge as they so often do at turning points? So just something to be paying attention to. This gap higher on Friday, push back down, created a doji. Doji could be a continuation or a reversal pattern, so be watching that in the daily time frame. But watching this negative divergence to see if it's done or if it's still under construction with that doji as a continuation pattern. Doji took us back above that upper boundary. Again, oftentimes you get an overthrow move here, and again, the doji could be a continuation or a reversal pattern. So we'll be watching what becomes of that. NASDAQ has formed this divergence on the RSI. The MACD is moving higher. If you look at that right there, it was almost equal, and now it's turning higher. So again, it still may end up trying to go higher if it is a continuation pattern, but again, it could be either one. NASDAQ has a high here. S&P's gone sideways and formed the triangle. I talked about that in my last video on the 60-minute chart. Now, if the doji is a continuation, NASDAQ still might try to make it to this trend line. I've talked about the channel on the S&P 500 here. If we connect these levels and these levels with our linear scaling directly overhead, we could reach that trend line. Here, I've excluded the lows over here and connected this low and this low, and you got a fairly nice looking channel on the linear scaling. You've got these divergences that are still in play here in the weekly time frame. Now, again, this is a trend line in the linear scaling that I'm looking at. If we can continue a little bit higher, if our doji is a continuation in the daily time frame. Again, our linear scaling, we have a larger channel going back to the pandemic low here, and again, we've overthrown the upper boundary right there, and we could be moving towards this upper boundary right here. Again, a channel within that larger channel, but overthrowing this level clearly at this point. Again, the divergence is in play on the RSI and on the MACD. Now here it is up close, and again, the gap higher, and then the rally, and then the push back down, and then the rebound back up on the 60-minute chart created this candlestick, this doji candlestick. Remember, we had the bearish inside day, but the candle was never confirmed. I told you again, in order for a candle to play out, it has to get confirmation and a follow through. Same thing here. Do we have it be a continuation to the upside or a reversal? And if so, then we would have to close below the low and then get a follow through and see evidence of a reversal if that is going to be the case here in the daily time frame. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel today. I don't have any sponsors, just a direct relationship with you. I turn those offers down because I don't want to sell you a bunch of stuff. So I just ask that you help out as you can. I do need to hear from you in order to make it work. So please consider helping out today. Follow the link below to take you to a secured site, and you can donate any amount you want or make it a recurring donation. If you do that, I thank you. Thank you for your consideration for that. Watch the video all the way through. The recession is coming as we're coming up and slamming up into these trend lines in the monthly time frame. The Dow has just overthrown the monthly trend line. The S&P is come up, overthrew it, and it's pretty much right at it right now. And here we are. We've come up to it now here in the monthly time frame for the NASDAQ. Get that candle of indecision. If we go a little higher, we have the trend line there in the weekly time frame. Right at this one right now. Obviously, had we excluded the shadow here, we were at the trend line connecting the peak here and the peak here. If we exclude the shadow, if we include the shadow from the 2000 top, then we're right at that level right now. Again, a long-term parallel channel. If I zoom in on the NASDAQ monthly chart, again, you can see we're slamming up into that trend line. We tagged it. We moved just off of it a little bit with the highs of the week with the doji. Again, S&P started to overthrow it a little bit. We may see that with NASDAQ. The Dow clearly is throwing over overthrowing the upper boundary channel, overthrowing it like we did in 1929. Try to take the time to show you that chart next week. Just some things to be aware of with the NASDAQ. What I'm going to be talking about right now is, again, we've got the uninverting of the yield curve. We're going to have a recession. Three things are associated with the recession: a stock market top, the Fed rate cuts, and the uninverting of the yield curve. Here in 2001, the uninverting of the yield curve, the market had already peaked in 2000. Fed was late with rate cuts again. When we had the inverting of the yield curve between the 10 and the 3-month, 2 months later, we had it January, 2 months later. In March, we were in recession. So that's why I'm saying it could show up immediately. Now, in 2007 and 8 there, it was a little bit longer. We could see it show up in a couple of months, or the recession, or a few months, meaning we could see the market peak. I'm telling you, we're going to get emergency cuts out of the Fed because they're always blindsided by it. Here in 2000 and 2001, we got the uninverting of the yield curve. 2 months later, the recession began. 2007, we got the uninverting of the yield curve. More about the topping process in a moment. About 5.5, 6 months later, we were in recession. Market peaked ahead of that recession. Here we got the topping process. After the uninverting of the yield curve happened in 2001, we already had the topping process. I'll talk more about that in a moment. The point is, after the uninverting of the yield curve, within a few months, recession showed up with the bursting of the tech bubble and with the financial crisis. We are just a few months away from recession. It's likely going to hit in the first or second quarter. A pretty good shot. You're going to see a top here very soon, likely surrounding the trend lines I've been talking about in the monthly time frame and the weekly time frame. Last update, I talked about the uninverting of the yield curve between the 10 and the 3-month. Warning, the recession is getting even closer. Now, right now, we've had the uninverting of the yield curve in September with the 10 and the 2-year, 10-year and the 2-year, and now we get it, and then we had the Fed begin right after September. That occurred in September. We had the Fed begin to pivot and to begin to cut rates. We get this signal in December between the 10 and the 3-month. And again, as of the previous week, we had a new peak in the stock market on the S&P 500. I still believe we're going to this upper channel line where I think that we're going to move into the high 6,100 area. And if we take our time reaching it, might go into 6,200. The trend line is the target. Then I think we're going to turn. We're hitting that long-term monthly trend line. Now, we got the Fed pivot. We got the Fed pivot rally that I've talked about. Okay. And again, we get the uninverting of the yield curve. These things are all associated. They're all associated with the coming recession. The market will begin to top, price in the coming recession before it hits. Fed begin to try to pivot and cut just before the recession hits. Times like right now, even when they're blindsided, they're believing their own propaganda. Oh no, we're gonna have the soft landing, we're lowering rates and all this stuff. It's a bunch of Kool-Aid, okay? For the willfully ignorant of history. You get the uninverting of the yield curve, the 3-month, the 10-year, 2-year, and right before the recession hits, the uninverting of the 10-year and the 3-month, which is what we're seeing right now. These things are all associated with the recession. These events before the recession, the Fed pivot, or sometimes it's late, like in 2007, the recession already began, and then they panicked right after the recession began. But here, they're doing it before the recession begins. Gonna see the emergency cuts. I'm telling you, they're coming. They came in 2001. They came in 2008. The Fed, a history of being blindsided by the recessions, blindsided by the one that's about to start right now. So here you have it, okay? The uninverting of the yield curve, the Fed pivot here. Now I want to show you what happened in 2000 and 2001 and what happened in 2007 and 2008. Here we're getting the Fed pivot. Now we're getting the uninverting of the yield curve that's following, okay? And we're probably going to see a stock market top very soon. Guess is that's going to be in December or January. I think you're going to see the recession hit in the first or second quarter. My guess is the first quarter. The Psalm rule, it would be 6 months. By January, if we make it 9 months, again, maybe we're looking at the recession hitting by April, early second quarter. But I think you're going to see it in all likelihood in the first quarter. So we're going to be looking for a stock market top. These things have been associated with that and have also been associated with the coming recession. A very reliable indicator, the uninverting of the yield curve. Now keep this in mind. Look what happened in 2000 and then look at what happened in 2000. Now look what happened in 2000 and 2001. Okay, we have up here the 10-year and the 3-month yield curve. Okay, we have the S&P 500 below. Here we had the S&P top first. That was followed. That was in March of 2000. At the beginning of January, it panicked. The stock market had dropped by 19.5%. Okay, Fed did their rate raising campaign in 2000. They paused. Market began to tank. It tanked by 19.5% from the high in March. We went back up. We tested the high in August. Okay, and a topping process with a lower high, 2000, and the market began to sink and panicked. We dropped 19.5%, and the Fed on January 3rd did an emergency meeting, and they cut by 0.5%. They started a series of jumbo cuts. That was the pivot. And right after that, we got the uninverting about a couple weeks later. We got the uninverting of the yield curve. The stock market had already peaked. The Fed had just cut rates with an emergency meeting, and we started seeing the steepening of the yield curve. And again, recession happened just a couple of months later by March. So we saw the uninverting of the yield curve, and the recession showed up 2 months later. Okay? Less than 2 months, actually. The Fed had cut their January 3rd, and again, by March, before the quarter ended, we were in recession in 2001. Stock market had long ago peaked the prior year. A whole year earlier, the stock market peaked, and by the time we got the recession, it had dropped even further. Bounced with the initial rate cuts off, and then the market even further. Hopes of tax cuts. People telling us, oh, we're going to get the extension of the tax cuts, and Trump is promising to bring in some favorable tax policies like no tax on tips, no tax on Social Security benefits, no tax on overtime, and deregulation. So there's a lot of hope about tax policy with President Trump. And while those things may be good, going to stop the recession. They didn't in 2001. They didn't stop the recession from happening. We're actually done as the recession had already kicked off. There was hopes of tax cuts and tax relief, and right when they were passed in June of 2001, buy the rumor, sell the news. And then right after that, we got the 9/11 attacks in 2000. And again, by then, the market had sunk dramatically. It would go even lower than that. I just blowing up the section of the chart to show you what's going on. There are people now saying, okay, we've had the election. We're getting the election rally because Wall Street likes President Trump's economic policies. It likes his tax policies, likes his deregulation. While those things may be good, Wall Street may like those things. It's not going to stop the recession. The damage has already been done, and the recession indicators are telling us we're about to have a recession. President Trump and his policies are not going to be able to stop the recession. They're going to take time to implement. Those policies, those tax policies, will take time to work their way into the economy. People don't understand. Damage has already been done. Trump's going to end up inheriting a recession if he implements some of the tax policies he's talking about, deregulation. That could maybe help shorten the recession. It could help ease some of the pain. It's not going to stop the recession. That's why I've compared this election very, very similar to 2000, because again, there was talk with the 2000 election. George W. Bush was coming into office. There was talk. He campaigned on favorable tax policies, and very similar to right now. It didn't stop the recession from happening. Cuts did not stop the recession and the bear market from happening. Do you understand what I am saying? No political figure is going to stop this recession from happening. No tax cuts are going to stop this recession from happening. It's already too late, and that's what people fail to understand. What was associated with the recession? We had the Fed cutting, we had the stock market top. The stock market actually topped first ahead of the Fed cutting, and then you had the inverting of the yield curve between the 10 and the 3-month, and recession followed right after that, just by March, and we had that uninverting of the yield curve in January. That's why I'm saying it could show up in the first quarter. Now, it doesn't always play out that way. There are different ways that it plays out. I still think like right now, the stock market's probably going to go a little higher, even though we've had the Fed already start cutting, and we now have the uninverting of the yield curve. But I think we're going to see a peak, and then I think we're going to see recession show up, likely in the first quarter. The Trump inauguration will take place. Congress will push through to get tax cuts, and tax cuts extended, and some of the other tax cuts that Trump campaigned on. But again, it's not going to stop it. Again, these things were associated with the coming recession. We had this run-up into election, just like we had the run-up here. The process was really completing as we are moving towards recession. And before election took place in November, the market had already started to sell off. That's where the difference is, because right here with the election, we're getting a rally. Rally back then that was associated with the Fed pivot was just this bump right here, okay? But the market had already long ago peaked. The point I'm trying to make to you is recession, this gray shaded area, recession began March of 2001. 9/11 attacks were over here in September of 2001. The tax cuts here and the stock market peaked long ago. The Fed began to cut. They began to do a series of emergency cuts because they panicked to begin with, and then they were blindsided by it. They started with a bunch of jumbo cuts. We're going to see that happen again. I always say it happened because the Fed is always blindsided. There are the cuts during the bear market and during the recession, the economic rebound that was attempted after that, and then on into the beginning of the bull market to the 2002 bottom. Here again, we began to see a series of jumbo cuts as the Fed was blindsided by the recession that was about to start. They should have already been cutting rates in 2000. They didn't start cutting until the emergency meeting in January 2001, and then that was right before the meeting at the end of the month in January. They did a 50 basis point cut, another 50 basis point cut, 2 cuts in January, another jumbo cut in March, and then they had another emergency meeting after March meeting in April, and they cut another 50 basis points. We're above 6%. They had cut them back down. They were at 6.5%, cut them down to 6%, and then kept cutting. And again, with that second emergency meeting down to 4.5%. Hit another 50 basis point cut to 4%. Then started a series of quarter point cuts, and again another emergency meeting by September of 2001 surrounding the 9/11 attacks of 2001. We got another series of jumbo cuts in October and November, and rates down to 2%. But again, a series of jumbo cuts, a series of emergency meetings, because the Fed started cutting late. Recession began in March, right after they began cutting. Should have been slashing rates in 2000. We saw the last of the rate hikes and then the pause, and the Fed waited too long. They panicked, and this is what happened. It's a whole bear market for 2000 for you. And by the way, after we had peaked there, when we began to drop below the 50-week moving average, we triggered a 50-50 sell signal, dropping below the 50 on the RSI, dropping below the 50-week moving average, and that played out. We held below that 50-week moving average throughout the decline of the bear market. And this is the whole thing. I cut it off on the previous chart, running the 9/11 attacks, which were right over here. But here you can see, I always get these people that say, can't have a bear market. We can't have a recession. The economy's good and the GDP is positive. Markets top on good news. We are now seeing the deterioration in the labor market, which I've been pointing out to you over and over. What happened right before the recession in 2007, December 2007, and also we're seeing that right now. But here again, we had the stronger GDP, 4% on an annual basis here. Even though we've recently seen positive GDP numbers, again, we're still seeing evidence of weakness in the labor market, which is pointing to a coming recession. Recession indicators being triggered. So again, and here's the tax cuts and so forth. But markets tend to top on good news and bottom on bad news. Where, again, people make their mistake. Oh, we have to have all this bad news for the market to top out. No, the markets top on good news. They bottom on bad news, on pessimism, top on complacency. Is what we have right now. Now, GDP was higher than what it is right now with the bursting of the tech bubble. The positive GDP and low unemployment rate and all these other things, again, and the positive job growth creation, it didn't stop the recession from happening. It didn't stop the bear market. Same is true for the 2007 top. Again, had positive GDP going into it. We have 52 months of job creation going into the topping process in 2007. It didn't stop the bear market. It didn't stop the recession. It didn't stop the economic downturn. And you have to understand that. Positive job creation right now, supposedly. I mean, who knows with the fake numbers that we continue to get out of the Labor Department, but supposedly they're still positive. Being told by fake numbers out of the Labor Department, oh, this proves we're not going to have, that we're not going to have a recession. We've got strong economic growth, and we're going into cuts, and we're going to have the bull market to 2025 and 2026 and continue onward and upward. Major trend lines of resistance in the monthly time frame. S&P 500, Dow, and the NASDAQ. We got bad numbers, negative numbers. By the time the bear market was going on, by the time we bottomed in 2009, the market bottomed on what? Bad news. It tops on good news. People believe the opposite. It's the 2007 top. The bear market that followed again. Notice the 50-50 sell signal. Again, we had the RSI drop below 50 right here. It got back above it briefly, and then it turned into a negative territory right here. Dropped below the 50-week moving average. Got back above it. Got a lower high. The final exit point. And then, again, the bottom just fell out of the stock market. And again, notice below that 50-week moving average, just like what we had in 2001. The 50-50 sell signal in the weekly time frame. Very, very powerful, powerful tool. Live it, love it, learn it. Again, we're comparing the events of 2024, the Fed pivot with the rate cuts, the inverting of the yield curve now between the 10 and the 3 month, and looking for a potential stock market peak. Again, these things are all associated with the recession. Same thing we just talked about in 2000 and 2001. Now 2007 and 2008, same thing. Again, it can unfold differently, each time. Very, very similar, and these things are associated with the recession. Here, we had the stock market peak in 2007 in early July at 1556 after the yield curve uninverted. The Fed had not begun to cut rates yet. They did not pivot till over here in September. Remember in 2000, when we got January, I should say, in 2001, when we got the inverting of the yield curve, the stock market had peaked long ago. Here, the stock market peaked just after completing the topping process. I think that we have the topping process nearly done. Our current situation here in 2024, and I think we'll see the stock market likely peak in 2024 here in December, or probably in January. One of those two. It doesn't likely going to be in the first quarter, but I think the recession is likely going to hit in the first quarter, so I'm looking for a stock market top likely in December or January. Nevertheless, I digress again. Had the uninverting of the yield curve first, okay, and that was in mid-May, okay, and that was between the 10 and the 3 month, okay, and the stock market went a little bit higher, and it went kind of sideways, and then it popped up to 1556. So it just kind of went just slightly higher to July. So we saw mid-May the peak, and then we saw it go there into early July. It dropped 12%. Early 12%. We got a rebound back up. We got the Fed pivot September 18th in 2007, 0.5%. The market peaked 3 weeks later. And remember, in 2001, the initial bump out of the Fed began to cut rates in 2001 in January, but they started with an emergency rate cut in 2001, in January of 2001, and they should have already been slashing. As I said here, they cut, so we had the uninverting of the yield curve, we had this peak right here, we sold off 12%, and we got the Fed cut. We peaked 3 weeks later, we went 20 points higher or so than this previous peak right here. We went to 1556, which was, again, about 25 points higher than the peak at 1550, which was the 2000 top. So again, we had that long period from the 2000 high where we went nowhere, and then we had another bear market. We only went 25 points above the 2000 top and about 20 points above this peak at 1556. The S&P topped on October 11, 2007, after the 3 weeks after the Fed pivot there began to sell off. We sold off 20.5%, and the Fed panicked. January of 2008, January 22nd, 2008, and I have 2022-8. Let me just fix that. 2008 there, the Fed did an emergency cut. We had already had cuts. I'm just marking the pivot here. We had started the cuts. The Fed was focusing on the inflation. They were not focusing on the recession when they should have been. Panicked when the market peaked right after they began the cuts. And again, recession began December. Now, had an initial bounce, but then we went on and sold off more. And again, recession had started in December, and it went on into 2009. I don't even have, I just stopped it here in September 2008. We had the Lehman moment and everything else, and it just went on until 2009. The stock market out in early 2009. We can go on and look at that as we saw in the other chart right here. Again, we had the bottom fall of the stock market there in 2008 with the financial crisis and the Lehman moment and all the rest of it, and finally it bottomed out in 2009. So this is what happened if we extend the chart further out. It bottomed, and eventually after that, the recession later ended here in 2009. It was a very long recession. The point is here we had the topping process. We had the uninverting of the yield curve. The market peaked shortly thereafter. Again, sold off 12% and then went back up and formed a double top and went slightly higher by 20 points. Okay, we didn't have this continuation with the uninverting of the yield curve, raging bull market where we just kept going. In either case, here we went sideways at best to form the topping process the uninverting of the yield curve was followed by the topping process where we went nowhere for a while. And 6.5 months later, we were in recession in December. So again, the topping process was associated with that. Again, in 2000, the market had already peaked. Yield curve happened after the market peaked, and the recession, after we got the uninverting of the yield curve in January, by March, we had the recession in 2001. So again, do you see what I'm saying? I'm saying the stock market top, the uninverting of the yield curve with the 10 and 3 month, and the Fed pivot and rate cuts are associated with the coming recession. Those three things here with the 2000 top and the 2001 uninverting of the yield curve and the rate cuts. Again, the Fed started off with the emergency cut immediately. They panicked here, and while they already did some cuts here in 2007, again they were focused on inflation, blindsided by the recession. And again, even though inflation surged higher, eventually it was dealt with about 11 months later. But again, even though inflation surged higher, the Fed still started doing the emergency cut, aggressively cutting thereafter in 2008. But again, in both cases, we're going to have a soft landing and all of the fairy tales that are associated with that. Just trying to tell you, look, the uninverting of the yield curve that we just got, recession followed 6.5 months later here, and it followed 2 months later when we got it in 2001, associated with the stock market top and the Fed rate cuts. Supposedly, the Fed is cutting right now to keep the economic expansion going. Again, the propaganda had the soft landing, Kool-Aid for the herd. But in both cases, the uninverting of the yield curve between the 10 and 3 month was associated with the recession. It was associated with the stock market top. Here, the market top shortly after it occurred, and it completed the topping process. In 2001, when the uninverting of the yield curve, the stock market had already completed the topping process and was already starting the bear market. Of the last the bear markets that we had, the uninverting of the yield curve was associated with the stock market top. Here, the topping process previously after the topping process. Here, the recession began 6.5 months later to complete the topping process. And again, we got the uninverting of the yield curve in early May. We peaked there in early July, sold off 12%, went back up, and peaked just under 5 months later, moving just, again, 20 points above this level to complete a double topping process. The point I'm trying to make is the uninverting of the yield curve, the recession is about to start. I think with the negative divergences in the weekly time frame, we are completing the topping process right now at the uninverting of the yield curve. Prices will go a little higher. The time to show this to you because, again, the rate cuts, the uninverting of the yield curve, stock market top, all associated with the coming recession here in 2007 and 8, and previously, as we looked at, in 2000 and 2001. Now, again, we had the Fed pivot September 18, 2007. I showed you that on the chart. They started off with 50 basis points, just like we did in 2024. It was actually the same date, September 18th. They did a 25 basis point in October. They did a 25 basis point in December. We're probably going to see that out of the Fed here next week. But then, again, recession hit in December, right 2 months after the Fed pivot in September. And they panicked, and they did an emergency cut of 75 basis points right ahead of the January meeting, where they did another 50 basis points, and after that in March, another 75. Again, the jumbo cuts. This is what's coming because the Fed gets blindsided to the recessions. 2007, they were focused on the inflation rather than the recession. They should have ignored the inflation and focused on the recession. They should have been slashing rates long before the emergency meeting. They should have been doing these rate slashes earlier and probably even before the pivot. But We would go on to have the Lehman moment. We would get another emergency meeting in October and 50 basis points another. And then in December, taking rates down to basically nothing. And then the Fed kept rates too low for too long, making another monetary policy mistake when we got the QE infinity after rates down to nothing. We got the QE infinity and beyond all the rounds of QE, giving us now the largest bubble in history for U.S. stocks.